I'm Harish. Today we are going to be talking about cross-currency swaps. Here's the usual disclaimer. This is the property of Imarticus Learning. The video is for educational purpose, and any means to kind of republish this or copy or distribute it is obviously only by consent of Imarticus Learning. We've been talking about swaps actually, and let me just try and first explain, just to kind of summarize a bit in terms of what is a swap. Now, when you talk about a swap, and as the dictionary meaning would also convey, it's basically an exchange, right? A swap means you're either exchanging two interest rates or two asset classes, even for that matter. But for the reference and in our earlier discussion, we've talked about currency swaps, which is basically two different currencies being swapped between two parties in two different economies and so on. Today, the focus is going to be more about cross-currency swap. What is cross-currency swap? Now, the cross-currency swap involves both exchange of principal and interest. Now, in typical currency swaps, there could be only the interest rate that can be swapped, and it's very customizable. Any swap, for that matter, is an OTC contract, which means the party kind of come together and say, okay, this is what I want, this is what your terms and conditions are. They agree on the terms and conditions, and the swap takes place. So a cross-currency swap involves both the exchange of principal as well as the interest rate. Okay? And again, what interest rate are we talking about? Could be fixed, could be floating. And we'll dwell into these in more detail as we go on. Yeah? So the cross-currency swap, we'll take an example, of course, is where both the principals are exchanged in the first place and for a particular period, right? So in this entire ensuing period, there will be periodic interest payments as well, because as such, the principals are exchanged, some sort of a loan, or people are using those funds. So which means that there has to be an interest element to it. So there will be periodic interest payments as well, which again is also exchanged. And finally, at the end of the swap or the period, the agreed period or the maturity of the swap, the principals will be again swapped back. Yeah. So that's basically the mechanics. Now, when you talk about cross-currency swaps, again, as I said earlier, these are OTC contracts. OTC, over the counter. OTC is non-standard customizable contracts between two counterparties, each having their own requirements, terms and conditions, and when they come together, they agree on terms and conditions and they create a contract. And that's how an OTC product or a contract is done. Yeah. So here it's basically two parties come together, exchange principal and interest payments. And again, obviously, these are cross currency, which means two currencies, two different currencies have to be involved, right? In a cross currency swap, the interest payments are at fixed intervals. Again, what is this fixed intervals? Well, could be 3 months, could be 6 months. There are certain industry standards which will say, okay, there's a quarterly interest repayment or a 6-monthly interest payment. All of this, again, is a matter of discussion and part of the terms and conditions. Yeah. So as I said, customizable contracts where the interest is exchanged, whether fixed, whether floating, all of this, again, is pre-decided. Taking an example, so let's say there is a company in the UK and they have issued bonds in USD, in US, right? But basically, they are dealing in UK and they are now expanding into, let's say, US. And vice versa, the US company probably needs GBP, British pound debt they have to service that debt, or they need to raise funds for whatever reasons. Could be expansion, could be whatever their operational or financial reasons. Now, here is where both parties, as such, kind of come together. One is in US, wants British pound. The other one is in the UK and wants US dollars. So, clear-cut case of swap that can take place again. And as I've already talked about, principals, interest, and then principals swapped back. What is the difference between currency and cross currency? Yeah, the difference primarily is about the principals and the interest rate. The interest rate is the key here. Yeah, here we should understand that both currencies in their local economies command an interest rate, right? But because these two parties in their respective economies or countries, right, are having to pay their own interest rates, but for whatever reasons, and I'll discuss the reasons as well, need to swap and take advantage of the other currency because of their expansion plans or whatever, which means that they have to get into a contract and swap these interest rates. Yeah. So the difference as such is largely about the interest rate, the type of interest rate, the different rates of interest rate. Yeah, that's the key thing here. What are the benefits? Well, of course, the first and foremost is always when you enter such cross currency swap, uh, you are basically trying to mitigate the exchange risk in the first place, right? Because there are fluctuations in the exchange rate, which means that a company with their expansion plans, and these expansion plans and these needs are fairly medium to long term, which means that they are subject to a lot of exchange rate fluctuation, which can happen over 2, 3, 5, 7 years, just making it. Yeah, so they have to hedge this exchange rate risk, which is why a swap is a good idea. Yeah. Then, of course, because it's a customizable contract, people are talking to each other, customizing a contract. Of course, these are institutional players. It's not individuals as such here. So there are these two institutions who are talking to each other and entering into a swap, but they may be representing a corporate or a corporation or any other financial institution and so on. So the borrowing cost is reduced because it's a direct swap between the counterparty as such. In any other case, if they were to raise a debt or borrow funds from uh, the other country or the local market, then the borrowing cost would be higher. So here you have a very good advantage in terms of the borrowing costs being lower. And finally, because the swap is taken into consideration, the debt restructuring is possible. Yeah, a company would want to constantly look at its balance sheet and see how is it managing its debt as such. And the ability to get into such contracts and manage debt, um, structure it, restructure it, based on their view in terms of the next 2, 3, 5 years, in terms of how they want their balance sheet to look like, how is it that they want their capital structure to be. So the CFO or the head of the company, these people will take a decision in terms of how we want to kind of manage our debt and have our balance sheets looking like. So with the ability to do such cross currency swaps, you're able to kind of structure your debts well and so on. Yeah. Again, I've taken an example here. There is a company A which needed euro financing, right? Because it's got plans to uh, start operations or expand in the European region. So needs access to euro funds in the euro or European region as such. but obviously they are in US, so they would want to pay fixed US dollar interest as such. On the other hand, you have somebody in company, let's say company B in the European region, and they are today paying euro, euro interest as such, but they would want to kind of want to invest in US, which means they need funds in US, and they also need to then pay the interest in USD. So ideal state for two kind of companies A and B to get together and discuss this swap and get into an agreement and do a cross currency swap. So that's an example as such. Now there are obviously risks. There are some benefits. There will obviously be some risks. So while we talk about being able to mitigate exchange risk, and that's a benefit, which is why you get into a swap as such. But risk can only be mitigated, which means can be reduced to some extent, cannot be made zero, right? There'll always be, there'll be a currency risk for there could be events, there could be geopolitical situations, there could be economical reasons, business cycles, could be anything. So there will always be some fluctuation in the currencies, which means the risk will always be there. However, of course, the swap is entered into so as to kind of mitigate it to a large extent, but some element of currency risk will always be there. Then, of course, the counterparty risk, because this is an OTC contract. There is no standard exchange, or there's no central counterparty as such who can guarantee any sort of a credit risk mitigation. But because there are two parties, there will always be a counterparty risk that one party may default or may go bad as far as interest payments, or may delay on the interest rate payments and so on. However, there are mechanisms to mitigate those as well. And since this is at a institutional level, the counterparty risk is very negligible. But nevertheless, the counterparty risk is always there. Yeah. Complexity in management, the structure as such of the swap. Yeah, because this is a contract which is medium term or long term as such, could range from 2 years, 3 years, 5 years, and so on, right? You have to keep servicing that contract. You have to keep managing that. So there is a, let's say, I'm just taking it as an example. If there's a 5-year swap, let's say that's happening, right? And there is a quarterly interest payment, which means that every quarter there will be an interest payment, which means, the process or the operations around um, calculating the amounts, ensuring that the amounts are transferred, banks getting involved, the entire process, operations process needs to be managed every quarter, which means practically the team is kind of working on it to handle these operations. So some sort of a complexity in managing such products will be there. Let's talk about basis swap. Basis as such refers to a word which is in financial parlance more to do with the interest rate differentials as such, right? So a basis swap involves two parties exchanging interest rates. So here only interest rates are being talked about, right? But the benchmark is different, right? And we'll take an example, but just to kind of make it easier. If there are two floating rate interests, let's say, of different terms, of course, then there could be a 3-month LIBOR, there could be a 6-month LIBOR, right? So the referencing, the interest rate is referred to because it's a floating rate, which means that every month or every quarter, whenever the interest rate will have to be paid, that period interest rate will have to be taken. So where do you take that interest rate from? Okay, you refer the LIBOR. So the 3-month LIBOR and the 6-month LIBOR are referenced rates basically, and you kind of refer those and do the exchange as such. So the swap here is taking place on floating rates. No principal is exchanged. The interest rate is swapped, but the interest rate is of two different period or two different benchmarks. Yeah. So the notional amount is same. Obviously, it has to be same because then otherwise the 3-month, 6-month rate, there'll be a lot of difference. If one of the principal amount is 100 million and the other principal amount is 150 million, then obviously there'll be a lot of differential and it's not really swap as such. So the notionals, which is the principals, remain the same. The interest rates are basically benchmarked because they are floating. And floating means it will change every regular periodic interval that has been agreed on. So the two different benchmarks are taken into consideration, and based on that, these payments are made, these interest rates are exchanged at, of course, the agreed intervals. So conventionally, the swap is, again, it's, exchange of interest rates as such, but basically the notional is the same and the reference is the difference here. That's the only part. Yeah. So I've taken an example here where a company is tied to a 3-month LIBOR, whereas the other company is tied to a 6-month LIBOR. Both are LIBOR. Will the interest rate change? Yes, because money, the value for money for 3 months vis-a-vis the value of money for 6 months. It's to be different, right? If I lend someone some money for 1 year, vis-a-vis I lend someone money for 5 years, I will obviously have a different interest rate, agreed upon. So it's the time here, it's the period here which comes into play. Two different benchmarks, two different periods. That's basically the example of a basis swap. Now, again, why use a basis swap? So every swap as such, or these OTC products, there will always be an hedging element to it. Somewhere these institutions get into contracts which are in millions and hundreds of millions as such. There will always be some sort of a risk. Now, that risk needs to be hedged, which means if there is an interest rate exposure as such, and if I'm paying, let's say, floating rate interest, but the interest rate obviously is subject to change. And if the perception is that this interest rate can go unfavorable and can cause financial risk and loss, the need to hedge that risk becomes important, which means that such products come into play and the party gets into a contract like a basis swap and hedges the risk so that irrespective of the change in the interest rate, but because the swap is already entered into, the interest rate exposure is mitigated, or the risk is mitigated as such. So that's one. Secondly, the arbitrage opportunity. Now, arbitrage obviously means it's about two different either markets, either periods, either benchmarks. It's basically a price differential or it's an interest rate differential between two periods, simply because the two periods are different or the two benchmarks are different or two countries are different and so on, or two markets are. Conventionally, we understand arbitrage is about taking price benefit or price opportunities, price change, price differential opportunities between two markets as such. Here we're talking about the rate discrepancy or the rate differential between two interest periods as such, between two periods as such. So that's again an opportunity here. So one party may be looking at hedging the exposure. They already got a floating rate exposure as such, but they want to hedge it. The other party may think there could be an interest rate change, which could be an arbitrage opportunity, which could be an investment opportunity, an opportunity to make money, which is why the second party is getting into a basis swap. So I'm just kind of talking about the intentions behind getting into such contracts. Third, of course, is the better cash flow management. Obviously, when you have a swap designed which will suit the cash flows or the company's debt management and the money management as such, entering into such swap helps them to better manage their cash flows, right? Again, benefits are more or less similar. The flexibility in managing the exposure as such. There is an interest rate exposure, and that's a floating rate, which means that one doesn't know what will be the interest rates 3 months down the line or 6 months down the line. Hence, there is a risk. There is a probability of an adverse interest rate happening. So, better to get into some sort of a swap and hedge, mitigate that risk. Yeah. Cash flow alignment we've already spoken about, and the floating rate, because there is two different benchmarks, two different periods, there will be a difference in the two periods. There will be a basis which needs to be, which is subject to a risk and which has to be hedged or mitigated. And such a swap can help mitigate such a risk to a large extent as such. Yeah. Well, even as I said, so while any hedging mechanism is to mitigate the risk, but as I mentioned earlier as well, it cannot be completely done away with. There will be some element, even after getting into a basis swap, a floating rate basis swap. There will be some sort of a risk if there is some major divergence in the basis as such. So if there is a movement which is adverse and there is a divergence from the norm or whatever was expected, there will always be an element of risk which the company has to still bear. Liquidity risk. Liquidity risk is important because these are OTC swaps. These are between two counterparties. To be able to get into a swap and then also exit, or being able to take a counter view based on changes in the future scenarios, let's say, it may be slightly difficult. While, of course, given the fact that it's a huge market, uh, a lot of global investment banks play a very major role in bringing together corporations and institutions for such swaps. It's not as much as a liquidity risk, but yes, there will be an element because the the nature of the contract is OTC. It's customizable. So to get another party to agree on the same terms and conditions of the contract, or with those periods, um, floating rates, benchmarks, which means it's a very customized contract. So there will be element of some liquidity risk to be able to not able to find a counterparty in case one needs to exit the swap as such. Counterparty risk will always be there because you have no central counterparty. There are two individuals. When I say individuals, I really mean corporations. There is no retail participation and there's no individual as such. But there are two corporations, two large institutions, which kind of come together and get into a swap like this, which means there will be some sort of a risk where one party may go bad on or delay the payments for whatever reasons as such. So counterparty risk is what there'll be always there. With that, we kind of come to an end to this topic on cross-currency swaps and basis swaps.
Found this session valuable? Hit the like button, subscribe to our channel, and tell us in the comments below what topic we should dive into next.